What is money? Understand this before you ever think about investing. Most people think money is cash in their wallet, numbers in a bank account, or the paycheck they receive every month. That is how money looks on the surface, but that is not what money really is. Money is not wealth. Money is a tool created to make the exchange of value easier. Before money existed, people traded time for labor, labor for goods, and goods for survival. Money was introduced to simplify that process. It allowed value to move without friction. Here's the truth. Money does not create value. Money only represents value. Real value comes from work, skill, knowledge, products, services, and resources. Money is nothing more than a ticket that allows value to move from one person to another. This is why people who truly understand money never chase it emotionally. They focus on creating value, because money always flows to where value exists. Money has three core functions. First, money is a medium of exchange. It allows trade without matching needs. You do not need the seller to want what you have. Money becomes the universal connector. This is what makes large economies possible. Second, money is a unit of measurement. It measures value. It prices time, businesses, property, and opportunities. Money helps people compare and decide faster. But understand this clearly. Price is not the same as real value. Never confuse the two. Third, money is a store of value. It allows you to store today's effort for the future. But money does not store value perfectly. Inflation slowly destroys purchasing power. This is why saving money alone never makes anyone rich. Now understand the difference between money and assets. This is where most people fail. Money is a tool. Assets create or preserve value over time. Money sitting still does nothing. Assets work for you while you sleep. Smart investors do not hoard money. They convert money into assets. That is how wealth is built. Here is the core message. If you treat money as the goal, you will always feel like it is never enough. If you treat money as a tool, you learn how to control it. Understanding money will not make you rich overnight, but not understanding money will keep you poor for life. If you want to understand money, investing, and how real wealth is built, subscribe to this channel. In the next video, we will talk about why money has value even though it has no value of its own. Why does money have value? A piece of paper cannot feed you. A number in a bank account cannot keep you warm. By itself, money has no intrinsic value. Yet the entire world works for it. Society moves around it. The reason is simple. Money has value because people believe in it. The value of money comes from trust, not from paper, not from ink, not from digital numbers. It comes from a collective agreement that this money can be exchanged for goods, services, time, and human effort. As long as trust exists, money has value. When trust disappears, money becomes worthless. This trust is not accidental. It is built by power, by law, by financial systems, by governments and central banks. A government declares its currency legal tender. Taxes must be paid with it. Debts must be settled with it. That is how trust is enforced. Not because money is strong, but because the system behind it is. History proves one thing. When governments collapse, when laws lose authority, when people lose faith, money loses value. Inflation explodes. Paper money becomes meaningless. Money does not die because it is weak. Money dies because trust dies. This is how fiat money works. Modern money is no longer backed by gold. It is backed by promises. The promise that the government will protect the currency, the promise that the economy will continue to function, the promise that social order will remain. That is why fiat money is powerful and fragile at the same time. Printing money does not create wealth. Printing money only increases quantity. It does not increase value.
When money grows faster than real value, each unit of money loses purchasing power. Inflation is not an accident, it is a consequence. The consequence of broken trust. This is why the wealthy understand money differently. They do not ask how much money exists, they ask how strong trust is. They watch policy, they watch capital flows, they watch central bank behavior, because they understand one thing clearly. Money is a game of trust. The core message is simple. Money has value not because it exists, but because people agree that it does. Whoever controls trust controls money, and whoever does not understand this will always be the one who pays the price. If you want to understand how money truly works and how to protect your wealth from inflation and system risk, subscribe to this channel. In the next video, we will talk about the stages of money development and how money evolved over time.
The stages of money formation and evolution. Money did not appear by accident. It is the result of thousands of years of economic evolution and power struggles. If you want to understand money today, you must understand the path it has taken. Stage 1. Barter. In the early days, money did not exist. People traded directly. You had grain, someone else had meat. An agreement was made, and the trade happened. Simple, but deeply limited. Now imagine a king in that system. He needed to build cities. He needed to feed an army. He needed to wage wars. Barter cannot fund an army. It cannot collect taxes efficiently. It cannot manage an empire. This system worked for villages, but it failed at the level of power. Stage 2. Commodity money. People began to choose items with shared value. Gold, silver, salt, precious metals. These had value because they were scarce, durable, and recognizable. Money at this stage had intrinsic value. But the problem remained. Gold is heavy, hard to transport, hard to divide for taxation. A king could not pay tens of thousands of soldiers with sacks of gold every month. Power was still limited by physical reality. Stage 3. Metal coins and state authority. This is where the state entered. Coins were minted, standardized weight, stamped with royal symbols. Not for convenience, but for authority. When the king stamped his seal on a coin, he was declaring, "The value of this coin is guaranteed by my power." Taxes were collected with that coin. Soldiers were paid with that coin. Money became a tool of governance. Stage 4. Paper money. Paper money did not emerge because people demanded it. It emerged because governments needed money. In ancient China, paper money was issued to finance wars. In Europe, banks issued paper claims backed by gold. At first, every note could be exchanged for real metal. But when wars dragged on, when treasuries ran dry, that promise was broken. Paper money allowed governments to spend first and let the people pay later. Stage 5. Fiat money and monetary warfare. When money was detached from gold, monetary power became centralized. Money was no longer a claim on metal, it became a claim on trust and political authority. Modern wars are not fought only with weapons, they are fought with money. Printing currency, inflation, currency devaluation, interest rate manipulation. As described in monetary warfare theory, the nation that controls the monetary system wins without firing a single shot. Stage 6. Digital money and total control. Today, most money does not exist physically. It exists as numbers inside banking systems. With a single command, accounts can be frozen, transactions can be blocked. Power is enforced instantly. Money became invisible,
but control became absolute. Stage 7. Cryptocurrency and resistance. Cryptocurrency did not appear by chance. It was a reaction to centralized monetary power, a reaction to unlimited money printing. Blockchain replaces trust in people with code. No intermediaries, no permission. No one can print more at will. No one has absolute control. This is not just technology. It is a confrontation between centralized power and decentralized systems, between the old order and a new challenge. The core message: money always changes its form, but its purpose remains the same. Money reflects power, trust, and social structure. Those who understand money's evolution understand its future. Those who do not will always be the ones who pay the price. Call to action. If you want to understand money, power, and investing at a deeper level, subscribe to this channel. In the next video, we will talk about how money actually moves inside the economy.
How money really moves through the economy. Most people think money sits still in banks. That is not true. Money never stands still. Money moves. Money is like water. If water does not flow, it becomes stagnant. If money does not move, it loses value. That is inflation. Money does not sleep in a vault. Imagine you keep $1 billion in cash for 10 years. You do not spend it. You do not invest it. 10 years later, the number is still $1 billion, but its real value is gone. The house you wanted to buy today may cost 2 or 3 times more in 10 years. No one stole your money. Its purchasing power was slowly drained. The real power is not how much money you have, but how it flows. Many people believe a country is rich because it prints more money. That is a dangerous misunderstanding. A strong economy is not where money is printed, but where money flows correctly. When money flows into production, education, and technology, growth is real and sustainable. When money flows into speculation, bubbles are born. Even governments need money. Governments are not magical. They are massive organizations. They pay salaries, they build roads, they run systems, and in times of crisis, they must save the economy. When taxes are not enough, they borrow. When borrowing is not enough, they print money. Printing money is like painkillers. It works fast, but long-term use destroys the body. People do not see higher taxes. They pay through rising prices. Central banks control the heartbeat of the economy. Central banks do not produce goods. They control interest rates. Low interest rates mean cheap loans. Businesses expand. People spend. High interest rates mean expensive loans. The economy slows. Inflation is controlled. Every decision has a cost. There is no perfect solution. How commercial banks create money. This is what most people never understand. When you deposit money into a bank, the bank does not keep it locked away. They lend most of it out. Borrowers spend it. The money returns to the system. One original deposit can create multiple layers of new money. That is how money grows faster than real value. That is how asset bubbles are formed. Money follows belief. When people believe in the future, they invest. When people are afraid, they hold cash. During uncertainty, money flows into gold, real estate, and safe assets. During recovery, money flows into stocks and businesses. Money itself is not smart. Human emotion controls it. Inflation is a silent redistribution of wealth. Inflation does not affect everyone equally. Those who hold cash lose quietly. Those who hold assets may benefit. Asset prices rise with inflation. Cash does not. That is why people who understand money move it into assets. The core message: money does not move by itself. It is guided by policy,
by belief, by power. Those who understand money flow move ahead. Those who only look at bank balances will always be behind.